Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog slash newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about whether value investing is going to make a comeback. Is value versus growth is our topic today. We've talked about this before, but let's look at a newer angle. And the Financial Times has put out a recent piece on why value is the place to be currently. So let's examine some of the arguments which are being made and let's see where it takes us. So the piece is centered around this concept known as rope-a-dope, which is a Muhammad Ali concept. And for those of you who don't know who Muhammad Ali is, he is the greatest boxer of all time from the United States. And he was a world heavyweight champion. And he also was a civil rights movement figure who promoted rights for black folk in America. And he was also shunned for his lack of participation in the war in Vietnam, for which they took away his titles and medals. And they told him that he won't be able to compete in the World Heavyweight Championship. And once the war was over, he was allowed to come back and he won and he became World Heavyweight Champion again. So this is the legendary figure who the inspiration for this article. So rope-a-dope is basically when Muhammad Ali usually leans back on the rope and he lets his opponents tire themselves out. So the opponents keep punching and he keeps dodging and he may take a few hits to his face, but he generally keeps his arms up and he plays defensively. And the rounds go on, 2 rounds, 3 rounds, 4 rounds, 5 rounds, 6 rounds. And especially in his fight against George Foreman. Now, George Foreman is a boxer who is very muscular, much bigger than Muhammad Ali. He had a lot of muscle power and it was a contest of just raw power. George Foreman would have likely swept the floor with Muhammad Ali. So Ali basically came up with the rope-a-dope strategy where he basically let George Foreman, almost like an angry bull, let him charge at him and tire himself out. And then after a few rounds, he landed the knockout punch on George Foreman and took him out for good. And it was a KO. So this is the analogy which is being used in this article when he talks about value investing. So he says that when you're a value investor, you get beaten around quite a bit, and there's no denying that. And he says that you generally do tend to get knocked for 4s and 6s if you're a fan of cricket, or you get a nice shot to your face every now and then if you're a boxer. But, however, he asks the question, then why bother with value? If this is going to happen to you, then why do you want to even get into value? Why not just look at growth and do what everyone else is doing? Well, the truth is the only case in which you shouldn't go into value is when you truly believe that value companies will never come back and that they don't deserve any allocation in our portfolios. And the thing is, for that to happen, the market would have to completely shift in the way it operates from what it is, how it operates today. So there are 4 reasons which are listed. We'll go through them and then we'll look at their merits and demerits. So first of all, value is cheap. I mean, that's why it's called value. You can buy a value stock for a very low price to book, and you can buy a value stock for a very low price to earnings. And if you look at the book value of the cheapest 30% of the stocks in the world, and if you look at the 30% of the most expensive stocks in the world, the value, which is the bottom 30%, trades at a 25% of what the price to book is of the top 30%. So the price to book in value is only 25% of the number, which is the price to book of your top 30%. So that's interesting. So if your price to book in the top 30% of your companies was, let's say, 1, then the value stocks would be trading at a price to book of 0.25. This is quite good because we do generally want to buy a company for cheaper than what it's worth. And book value per share is nothing but the amount of assets per share once you divide it up by the total outstanding shares. So buying a company for under their book value is never really a bad strategy unless they are loss making, or you believe that a lot of their assets are gas. So if it's goodwill or something, goodwill is intangible. You can't really take it and sell it. If tomorrow the company is going to liquidate, you're not really buying. It's just an accounting phenomenon. So goodwill is a red flag which you have to keep in account. So, however, in general, if you're buying underneath book value, it is a good sign, considering the company is solid fundamentally. Okay. So then he goes on to say that from 2005 to 2007, value was expensive by historical standards, and the relative valuation of value, that is the bottom 30%, was actually at 40% of the price to book of the top 30%. I just said a lot of numbers here. Let me break it down for those of you at home. So you have the bottom 30% of shares, which are the least expensive, and you have the top 30% of shares, which are the most expensive. The top 30% of shares, let's say, is trading at a price to book of 1. The bottom 30% now is going to trade at 0.4 instead of 0.25. So by the summer of 2020, though, the graph will be on the screen. You can see that value stocks became cheaper. So it started trading at round about less than 10% of the price to book of the top 30%. So what I'm trying to say here is that today value stocks are only 1/8, that is 12% as expensive as growth stocks. So what this basically, the author is trying to basically say is that today if you're buying growth over value, you're assuming that growth is going to grow 8 times that of what value is growing at. That makes sense as to why you want to go into growth then. And if growth is not growing at 8 times what value is growing at, then maybe you want to consider the bottom end of the spectrum and look at value. However, there are caveats to this. The fact is, some value companies are loss making, which is why they are unfavored by the market. So, if you're loss making and you're burning capital, then the book value is going to keep coming down. So, your price to book will actually go up later. So, you have to be very careful in what value you invest. Not all value is really value. So, this is what he says. And secondly, the entire prolonged underperformance of value was not due to any trend in underlying fundamentals such as earnings growth. Value companies have been doing just fine. The fact of the matter is that the market has started favoring growth much more, especially post the great financial crisis. The market seems to be recollecting some of its optimism that it lost because of the great financial crisis as well as the dot-com bubble before that. So it seems to the author that the reason why value was underperforming is nothing inherently wrong with value. It's a great place to be, but rather that growth was favored just because of animal spirits and how investors perceived growth to be something where they should be. What do you have to say about the first two arguments he's trying to make?
Well, Muhammad Ali is one great example. The other great example is our Indian cricketer pair, Rahul Dravid and Lakshman. During test matches, in hot Chennai weather and Bangalore weather and all over India, Australian bowlers like Glenn Murka, they'll tire them out. He'll come running in from the boundary line and hurl at them. And he'll just drop the ball and play defense. And he'll keep playing defense for first few hours of the day. And in the heat, these boys can't take it. They come from Australia. They find the humidity and the heat too much. And they tire themselves out. Then after they've lost their spirit, back is broken, then they're just like bowling because they have no choice but to bowl. And they keep praying to God that Rahul and Lakshman will make some mistake and get out. So this is value investing. Yeah. It's about stamina. And having the tenacity, though there's pressure from every side and every corner, that you sit and you wait for the moment. And you allow things to play out. But that's a very hard thing to do. Because in youth, because majority of the people you're talking to are either close to your age or a little older than you. At that point in your life, it is very hard to curtail your emotions and to control yourself. To be a great value investor, it is someone who has great control over their mind and emotions. I know it sounds like some foo-foo, self-help guru kind of talk, but it's not. To be a great sportsman is to have mind control and not be swayed. Same is true with value investing. The reason why people switch over to growth investing is like young Virat Kohli during the under-19 when Indian Colts won the World Cup. That was a different Virat from what he is today. So every young investor who wants to be growth would like to play like Virat of those days or the Dhoni of Pakistan with his long hair. So I understand that because you want to go, you want to flash, and you you think you know what you're doing, and you think these are the things where the growth is and the market momentum is there. Yes, all of them do realize markets do go up and down and markets correct, but they feel like they're riding a surf wave, that they're riding, it's going up. Before the wave breaks, finally the wave will reach a crest and then it'll start falling. So they feel they're on the right side, and it's pure guesswork.
Yeah.
But it's very painful when you get hammered by a wave. When you're surfing, you're going up and it's all very fine and dandy, and suddenly the wave, you miscalculated and it wipes you out. That's why it's called a wipeout. It can really hurt massively. Yeah. So this can happen when you don't have a strategy right when you're doing growth investing. While in the flip, in value investing, because you're playing with patience, because you're doing with, keeping yourself together mentally, and resilience is what is required there. You may not see spectacular returns in the short term like a growth mindset, but you will see spectacular return in the long term. When you add up the years, the profits will start outpacing any growth strategy.
And I'll say, I don't know how people can reliably operate in the realm of growth, because it's so difficult, at least for me as an investor who's, a budding investor who's getting into this. It feels almost impossible for me to pick which horse is going to be the fastest horse to run.
No, but what happens is, when you start investing, you believe you can do it, because it's just like maths. If I learn the equations, I learn probability, I learn statistics, I spend enough time, applying my mind on these numbers, I can see the pattern. And I can see statistical analysis.
I would have never guessed AI would have gone as far as it has, the AI boom.
Yeah, and people feel that at that age, when you're especially new to the market, you've not done investing for a long time, you do believe, you tend to back yourself in, you back yourself up and you say, yes, I can do this, I can do this. And especially, let's say you do 10 trades and 5 of them, 6 of them go your way. Immediately you start getting confidence and you're like, okay, I can do this. Till you take a gamble too large and you get hammered. And that one hammer can destroy everything you built in a moment of a flash burn, and it will destroy you. So, and then after that, everyone becomes a value investor. Yeah. All value investors at some point of time believed in being growth. It's after getting hammered by growth, they become value investors. This is even true in the case of Warren Buffett. If you really trace and see what all he did before the age of 50, and you see how Berkshire Hathaway came in his hand, and how before Charlie came and held his hand and told him to calm down a little bit, Warren was like really flash in the pan. Yeah. Now, retro back hindsight, we're all like, oh, Warren. But no one would have betted Warren if you had met him in those early days. He found it hard to get people to sign up for his investing. His dad's friends in his network, like this he was doing. Yeah. And he admits it also. He says, I was very lucky. The ovarian lottery was that. His father had enough influence and friends who will back him and believe in him and give him a little cash on the table. Yeah. Because they're all well to do. They're like, okay, let this poor boy, our friend's son, let him have $100,000. Let him try whatever he wants.
That's fair.
Now it's all hindsight, yes. But if I was a guy who only had $100,000 and a young Warren walked into my office,
you wouldn't have given it to him.
Even today, you will not give it.
Yeah.
So remember that.
So there are 2 more reasons. Let's go through that. Thirdly, the author says that value reliably beats growth during periods of rising inflation. So the reasoning there, so let me explain why he says this. In the article, the explanation is not so elaborate, but I can do something for the viewers. So during times of inflation, the author makes the assumption that, look, interest rates are going to go up. If interest rates go up, then, like I said, the discount rate goes up. So when we talked about NVIDIA and said that they're looking at earnings 2026, 2027, this is growth, of course, but this growth is being discounted at the present rate, which is 5% or 5.25%. And the market assumes that the interest rates are going to come down. But if interest rates don't come down to where the market assumes it to be, then you're going to face a big upset in the market, especially for these growth investors who've already made their prediction based on a different discount value. And that's why you're seeing certain AI stocks actually come down, because markets are now adjusting to new information that, okay, maybe interest rates may not come to where I expected it to come to. Yes, it's going to come down probably, but maybe not to the extent which I expected. And that means that I may have to recalculate what I calculated before. So, but however, higher inflation and higher interest rates supposedly do not affect value stocks as much. I disagree with this slightly, because certain value stocks are quite debt-ridden. If you're debt-ridden, interest rates are going to be quite incisive. However, if you're investing in value without debt, then I think you're in good shape, because if you don't have debt, then interest rates, you basically defang the snake that interest rates can be to these enterprises. So the debt isn't as expensive, because if you don't have any debt, then you don't have to worry about your debt getting more expensive. So in this angle, I think the author needs to clarify that he means value companies with not much debt. Because if these are companies which are heavily indebted, like a lot of small cap companies are, then they'll be in serious trouble when interest rates are persistently high. Is what I think. What do you think about that?
Yes. Problem with debt is a two-edged sword.
Yeah.
Small cap companies require money to grow, and nobody will give small caps a lot of money because they're a small cap. You do not know if ideas are going to come to fruition. So they do tend to borrow. But all large caps were small caps. So it's very difficult that's why we say avoid small caps, because it's very hard to say which small cap. It's like meeting a young kid on the road and saying he's going to be the next Dhoni. We don't know. It's possible, maybe not, but I won't put money on it. And that's the problem with small caps. And when you're talking about inflation and how market future earnings are factored in, it's like a good example will be the government. How government always spends in deficit. Which you see the government budget. It is not the money it has that's allocating. The finance minister will say next year we're going to make so much money. We project to make this kind of money. From here and there we'll make money. We'll put these kinds of taxes and make money. So because we're going to make all that money next year, we're going to spend this now. So that's how deficit spending works. And then of course you know what happens to the government and the country. It doesn't go according to plan, and then we end up with a negative balance sheet, and that keeps expanding and growing because government keeps borrowing. So this is very true. And this happens in markets too. When you kind of forecast the future earnings and so it's all fine as long as the market is in a bull run and everything is going up. But suddenly when there's a huge correction and correction becomes sticky and hangs around for a while, all these future earnings you projected suddenly evaporates and becomes all negative, and you're left wondering what will survive this.
You just have a metaphorical stock certificate in your hand.
Correct, yeah.
So, right, and that's pretty good. And let's just quickly go through the last point, because it's important. Fourthly, growth beats value reliably in the late stages of a bull market, not so much in a bear market or the early stages of a renewed bull trend. So what the author is trying to say is that when you do have animal spirits working overtime and everyone's jubilant and everyone is euphoric, there's a lot of excesses which are possible. People are predicting 10 years into the future, 15 years into the future, and you have companies being taken to sky high levels. However, he says in a bear market, when no one wants to get on the riskier end of the spectrum, that is predicting even 3 years into the 2 years into the future or even the next year, during that period, what is there today is going to be valued a lot more than what may come tomorrow. So a bird in the hand is going to be worth more than two in the bush in this current scenario if it's a bear market. And your bird in the hand is your value stock. So what the author is saying is that during a bear market, value stocks are going to be much more favored because they are something which you have right now with its book value and its assets, rather than something which is there tomorrow. So that's one. And secondly, he says that even the early stages of a renewed bull trend, it takes some time for the market to kick into high gear and do what it does best, which is get euphoric and jubilant. So until that happens, value is going to outperform during that period. But there's another caveat here. The caveat here is the fact that markets are biased towards bull markets compared to bear markets. You don't have at least we haven't had a protracted period in which we've been able to snag companies at very low valuations in the recent past. Maybe it will change in the future. Maybe Jerome Powell will be happy to let the market stay in a sort of bear market for a while if that happens. But as things stand today, the Federal Reserve has made timely interventions to make sure that no protracted bear markets occur. So during this period, it becomes a sort of drawback to this idea because you won't get much time for your value to outperform. Yes, you'll have some time, but not much. So unless something changes about that, this is one point to keep in mind when you look at that.
True. I agree with that.
Yeah. So that being said, these are all the points, and we'd like it if you guys have some opinions on these 4 points. Do you think the author made a good point? Do you agree with us? Do you feel like we missed out on something? Please leave all your thoughts in the comment section below. That being said, we hope you enjoyed this video. Please like the video if you like watching it. Please hit subscribe if you haven't already. Hit the bell icon to get notified of our latest uploads. And finally, as I said before, please do leave your comments in the comment section below. We will make it a point to read your comments. Thank you very much for joining us on Be Rich.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.